All right, reading 45, security market indexes. Learning outcomes. The candidate should be able to describe a security market index, calculate and interpret values, price, returns, and total returns of an index, describe the choices and issues, index construction and management. Compare the different weighing methods used in index construction, calculate and analyze the values and returns of an index given its weighting method, describe rebalancing and reconstitutions of an index, describe uses of security market indexes, describe types of equity indexes, describe types of fixed income indexes, describe index risks representing alternative investments, compare types of security market indexes. Introduction, and investors gather and analyze vast amounts of information about security markets on a continual basis because this work can be both time-consuming and data-intensive. Investors often use a single measure that consolidates this information and reflects the performance of an entire security market. Security market indexes were first introduced as a simple measure to reflect the performance of U.S. stock markets. Since then, security market indexes have evolved into important multi-purpose tools that have investors track the performance of various security markets, estimate risk, and evaluate the performance of investment managers. They also form the basis for new investment products. Is this the Anzac Bridge in Sydney? I always get confused. Okay, this reading is organized as follows. Section 2 defines a security market index and explains how to calculate the price returns and total returns of an index for a single period and over multiple periods. Section 3 describes how indexes are constructed and managed. Section 4 discusses the use of market indexes. Section 5, 6, and 7 discusses various types of indexes, and final section summarizes this reading. Practice problems follow the conclusion and summary. Index definitions and calculations of value of and returns. Security market index represents a given security market segment or asset class. Most indexes are constructed as portfolios of marketable securities. The value of an index is calculated on a regular basis, either using the actual or estimated market prices of the individual securities, known as constituent securities within the index. For each security market index, investors must encounter two versions of the same index. One version based on price returns and one version based on total returns. As the name suggests, price return index, also known as price index, reflects only the prices of the constituent securities index within the index. A total return index, in contrast, reflects not only the prices of the constituent securities but also the reinvestments of all income received since inception. At inception, the value of the price and total return versions of an index are equal. As time passes, however, the value of total return index, which includes the reinvestment of all dividends and or interest received, will exceed the value of the price return index by an increasing amount. Look at how the values of each version are calculated over multiple periods illustrates why. Here is such. The divisor is the number initially chosen as inception. It is frequently chosen to that price index has a convenient initial value such as 1,000. The index provider then adjusts the value of the divisor as necessary to avoid changes in the index value that are unrelated to the changes in the prices of its constituent securities. For example, when changing index constituents, index price providers may adjust the divisor so that the value of the index with new constituents equals the value of the index prior to the change. Index return calculations, like calculations of investment portfolio returns, may measure price returns or total returns. Price returns measures only price appreciation or percentage change in price. Total returns measure price appreciation plus interest divided by other distributions. Let me close my window real fast. The window is kind of big. Okay, just closed my window. Calculations of single period returns For a security market index, price returns can be calculated in two ways: either the percentage change in valuation, the price return index, or the weighted average of price returns of the constituent securities. The price return of an index can be expressed as such. Similarly, price return of each constituent security can be expressed as such. Okay. Calculation of index values over multiple time periods. The calculation of index values over multiple time periods requires geometrically linking the series of index returns with a series of price returns for an index. We can calculate the value of the price returns index with the following equation. For an index with an inception value set to 1,000 and price return of 5% and 3% for period 1 and 2 respectively, the values of price returns index will be calculated as follows. Similarly, the series of total returns for an index is used to calculate the value of the total return index with the following question. Suppose the same index yields an additional 1.5% return from income in period 1. And an additional 2% in return in income period 2, bringing a total return from period 1 and 2 respectively to 6.5% and 5%. The values of total return index will be calculated as follows. As illustrated above, as time passes, the value of total return indexes, which includes the reinvestment of all dividends and or interest received, exceeds the value of the price return index by an increasing amount. Index construction and management. Constructing and managing a security market index is similar to constructing and managing a portfolio of securities. Index providers must decide the following: which target market should the index represent, which security should be selected from the target market, how much weight should be allocated to each security in the index, when should the index be rebalanced, when should the security selection and weighting decision be re-examined. Target market and security selection. The first decision in index construction is identifying the target market, market segment or asset class that the index is intended to represent. The target market may be defined very broadly or narrowly. It may be based on asset classes, geographic regions, the exchange on which the securities are traded, and or characteristics such as investment style, duration, and credit quality. The target market determines the investment universe and securities available for inclusion in the index. Once the investment universe is identified, the number of securities and the specific securities to include in the index must be determined. The constituent securities could be nearly all those in the target market or a representative sample of the target market. Some equity indexes such as the S&P 500 index and the FTSE 100 fix the number of securities included in the index and indicate the number of the name of the index. Other indexes will allow the number of securities to vary to reflect changes in the target market or maintain a certain percentage of the target market. For example, the Tokyo Stock Price Index, or the TOPIX, represents and includes all of the large stocks known as the first section listed on the Tokyo Stock Exchange to be included in the first section, and thus the TOPIX stock must meet certain criteria such as the number of shares outstanding and the number of shareholders and market capitalization. Stocks that no longer meet the criteria are removed from the first section, and also the TOPIX objective or mechanical rule determine the constituent securities of most but not all indexes. The Sensex of Bombay and the S&P 500, for example, are selection committee and more subjective decision-making rules to determine constituent securities. Index weighting. The weighting decision determines how much each security to include in the index and has a substantial impact on the index's value. Index providers use a number of methods to weigh the constituent securities in an index. Indexes can be price weighted, equal weighted, market capitalization weighted, or fundamentally weighted. Each weighting method has its own advantages and disadvantages. Price weighting, the simplest method, to weighting an index is to use the Charles Doll to construct the Dow Jones Industrial Average is price weighting. And price weighting, the weight on each constituent security is determined by dividing its price by the sum of all the prices of the constituent securities. The weight is calculated using the following formula. Exhibit 1 illustrates the value weights and single period returns following the inception of price-weighted equity index with 5 constituent securities. The value of the price-weighted index is determined by dividing the sum of the security values by the divisor, which is typically set at inception to equal the initial number of securities in the index. Thus, in our example, the divisor is 5. And the initial value of the index is calculated as 101.5 divided by 5, which is 20.3. As illustrated in the exhibit, security A, which has the highest price, also has the highest weighting and thus have the greatest impact on the return of the index. Note how both the price returns and the total returns of the index are calculated on the basis of the corresponding returns and on the constituent securities. A property unique to price-weighted indexes is that a stock split and the constituent security changes the weight on all the securities in the index. To prevent the stock split from resulting in new weights from changing the value of the index provider must adjust the value of the divisor as illustrated in Exhibit 2. Given a 2-for-1 split in security A, the divisor is adjusted by dividing a sum of constituent prices after the split, the value of the index before the split, the adjustment resulting in changes on the divisor of 5 to 3.69. So the index value maintains at 21.00. The primary advantage of price weighting is its simplicity. The main advantage of price weighing is that it results in arbitrary weights for each security. In particular, a stock split in any one security causes arbitrary changes in the weight of all the constituent securities. I mean, that makes sense using the what's it called? The weight. What kind of weight is this? The price weighting. Okay. Equity weighting. Another simple index weighting method is the equity weighting method. This method assigns an equal weight to each constituent security at inception. The weight as calculated as such. To construct an equal weighted index from 5 securities in Exhibit 1, the index provider allocates 1/5 or 20% of the value of the index to each security, dividing the value allocated to each security by each security individual stock price determines the number of shares of each security to include in the index. Unlike a price weight index where the weight is arbitrarily determined by market prices, the weight of equal weighted index are arbitrarily assigned by the index provider. Exhibit 3 illustrates the values, weights, and single period returns following exception of an equal weighted index of the same constituent securities as those in Exhibit 1. This example assumes a beginning index portfolio value of 10,000. To set the initial value of the index to 1,000, the divisor is set to 10 multiplied by 10,000 divided by 10, which is 1,000. Exhibit 1 and 3 demonstrate how different weighing methods result in different returns. A 10.4% price return on an equal weighted index shows Exhibit 3 differs significantly from a 3.45% price return of price weighted index in Exhibit 1. Like price weighing, the primary advantage of equal weighting is its simplicity. Equal weighting, however, has a number of disadvantages. First, securities that constitute the largest fraction of the target market value are underrepresented. The securities that constitute a small fraction of the target market value are overrepresented. Second, after the index is constructed, the price and constituent securities changes. The index is no longer equally weighted, therefore maintaining equal weight requires frequent adjustments or rebalancing in the index. Market capitalization weighting. In market capitalization weighting or value weighting, the weight of each constituent security is determined by dividing its market capitalization by the total market capitalization of all the securities in the index. Market capitalization or value is calculated by multiplying the number of shares outstanding by the market price per share. And this is the calculation formula. Exhibit 4 illustrates the values, weights, and single period returns following inception of a market capitalization weighted index for the same 5 security markets. Security A with 3,000 shares outstanding and a price of 50 per share has a market capitalization of 150,000 or 26.29%. Calculated as such of the entire index portfolio. The resulting index weights in the exhibit reflects the relative value of each security as measured by the market capitalization as shown in Exhibit 1, 3, and 4. The weighting method affects the index's returns and price. The total returns of the market capitalization index in Exhibit 4 differ significantly from those in the price-weighted and equal-weighted indexes. To understand the source of magnitude of the difference, compare the weights and returns of each security under each of the weighted methods. The weight of security A, for example, ranges from 49.26% and its price-weighted index to 20%, and an equal-weighting index with a price return of 10%. Security A contributes 4.93% to its price returns of its price weighting index, 2% to the price return of the equal weighted index, and 2.63% for the price return of the market capitalization weighted index, 2.63% to the price return of the market capitalization weighted index with a total return of 11.5%. Security A contributes 5.66% to the total return of the total weighted index, 2.3% to the total return of the equity weighted index, and 3.02% to the total return to the market capitalization weighted index. Float adjusted market capitalization weighting. In a float adjusted market capitalization weighting, the weight of each constituent security is determined by adjusting its market capitalization for its market float. Typically, market float is the number of shares of the constituent securities that are available to the investing public. For companies that are closely held, only a portion of shares outstanding are available to the investing public. In addition to excluding shares held by controlling shareholders, most float-adjusted market capitalization weighted index are excluded shares held by other corporations and governments. Some providers of indexes are designed to represent the investment opportunities of global investors, further reduce the number of shares included in the index by excluding shares that are not available to foreign investors. The index provider may refer to these indexes as free float adjusted market capitalization weighted indexes. Float adjusted market capitalization weighted indexes reflect the shares available for public trading by multiplying the market price per share by number of shares available to the investing public rather than the total number of shares outstanding. Currently, most market capitalization weighted indexes are float adjusted, therefore, unless otherwise indicated, the remainder of this rating market capitalization weighting refers to float adjusted market capitalization weighting. Float adjusted market capitalization weighting. Securities I is calculated as such. Exhibit 5 illustrates the values, weights, single periods, returns following inception of the free float adjusted market capitalization weighted index. The primary advantage of market capitalization weighting is that constituent securities are held to proportion to the value of the target market. The primary disadvantage is the constituent securities whose prices have risen the most have the greater or lower weight of the index. A security price rise relative to other securities in the index in its weighted increases. And as its price decreases, the value relative to other securities in the index's weights decreases. This weighting method leads to overweighted stocks that have risen in price and underweighted stocks that have declined in price. The effect of weighting method is similar to the momentum investing strategy, in that over time the securities have risen in price. The most will have the largest weights in the index. Fundamental weighting. Fundamental weighting attempts to address the disadvantages market capitalization weighting by using measures of a company's size that are independent of its security price to determine the weight of each constituent security. These measures include book value, cash value, revenues, earnings, dividends, and number of employees. Some fundamental indexes use a single measure, such as total dividends, or to weight the constituent securities, whereas others combine the weight of several measures to form a composite value of the use of its weightings. Relative to the market capitalization weighting index, the fundamental index with weights based on such a item as earnings will result in greater weights on constituent securities with earning yields that are higher than earning yields of the overall market weighted portfolio. Similarly, stocks with earnings yields less than the yield of an overall market weighted portfolio will have lower yields. For example, suppose that there are two stocks in the index. Stock A has a market capitalization of 1 billion or 1,000 million. Both companies have earnings of 20 million. An aggregate earning of 40 million, thus stock A has an earnings yield of 10%. So this is just an example. The most important property of fundamental weightings is that it leads indexes that have a value tilt. The is fundamentally weighted index has ratios of book value, earning dividends, etc. The market value that are higher than its market capitalization weighted counterparts. Also, in contrast to the momentum effect of market capitalization weighted indexes, fundamentally weighted indexes generally will have a contrarian effect in that the portfolio weights will shift away from securities that have increased in relative value and towards securities that have fallen in relative value whenever the portfolio is rebalanced. Index management, rebalancing, and constitution as so far. Index management, rebalancing, and reconstitution. So far, we have discussed index construction. Index management entails the two remaining questions. When should the index be rebalanced? When should the security selection and weighting decision be re-examined? Rebalancing. Rebalancing refers to adjusting the weight of the constituent securities to the index to maintain the weight of each security consistent with the index weighting method. The index provider rebalances the index by Note, for example, that the weights of the securities in the equal weighting index at the end of the period are no longer equal to 20%. So this is just rebalancing the weights of the securities within the index. In rebalancing the index, the weights of securities D and E would be decreased, and the weights of securities A, B, and C would be increased. Thus, rebalancing creates turnovers within an index. Price-weighted index are not rebalanced because the weight of each constituent security is determined by its price. For market capitalization weighted indexes, rebalancing is less of a concern because the index largely rebalances themselves. In our market capitalization index, for example, the weight of security C automatically declines from 10.96% to 6.91%, reflecting the 36% decline in its market price. Market capitalization weights are only adjusted to reflect mergers, acquisitions, liquidation, and other corporate actions between rebalancing dates. Reconstitution. Okay, let me check this out first. Reconstitution is the process of changing the constituent securities in an index, and is similar to the portfolio managers deciding to change the securities to his or her portfolio. Reconstitution is part of the rebalancing cycle. The reconstitution date is the date in which index providers review the constituent securities, reapply the initial criteria for inclusion in the index, and select which securities to retain, remove, or add. Constituent securities that no longer meet the criteria are replaced with securities that do meet the criteria. Once the revised list of constituent securities is determined, the weighted method is reapplied. Indexes are reconstituted to reflect changes in the target market and or to reflect the judgment in the selection committee. Reconstitution creates turnovers in a number of different ways, particularly for market capitalization weighted indexes. When one security is removed and another is added, the index provider has to change the weights of the other securities in order to maintain the market capitalization weighting of the index. The frequency of the reconstitution is a major issue for weighting for widely used indexes and their constituent securities. The Russell 2000 index, for example, reconstitutes annually and is used as a benchmark by numerous investment firms. And each year, prior to the index's reconstitutions, the managers of these funds buy stocks that they think will be added to the index, driving these stock prices up, and sells the stocks that they think will be deleted from the index, driving these stocks' prices down. Exhibit 6 illustrates the potential impact of these decisions. Beginning in late April 2009, some managers begin acquiring and bidding up the price of Uranium Energy Corporation, or URAC. because they believe that they will be included in the reconstituted Russell 2000 index. On the 12th of June, Russell listed Jack as the preliminary addition to the Russell 2000 index and Russell 3000 index. By the time the stock value has increased by more than 3,300%, investors continue to bid up the stock price. In the weeks following the announcement, and the stock closed in a reconstituted date of 30th of June at USD $2.9, up nearly 400% for the quarter. I mean, that's basically a penny stock, though. Okay, quite interesting. Uses of market indexes. Indexes were initially created to give some sense of how particular security markets perform on one given day. With the development of modern financial theory, or use of investment management have expanded significantly. Some of the major uses of indexes includes gauges of market sentiment, proxies for measuring the model returns, systematic risk and risk-adjusted performances, proxies for asset classes, and asset allocation models, benchmark for actively managed portfolios, and model portfolios for such investment products as index funds and exchange traded funds. Investors using security market indexes must be familiar with how various indexes are constructed in order to select the index or indexes most appropriate for their needs. Gauges of market sentiment. The original purpose of stock market indexes was to provide a gauge of investor confidence or market sentiment as indicators of collective opinion and market participants. Indexes reflect investor attitudes and behaviors. The Dow Jones Industrial Average has a long history, is frequently quoted in the media, and remains a popular gauge of market sentiment, and may not be accurately reflect the overall attitude of investors in the market. However, because the index consists of only 30 of the thousands of U.S. stocks traded daily, proxies and measures of modeling return, systematic risk, and risk-adjusted performance. The capital asset pricing model of CAPM defines the beta as the systematic risk of the security with respect to the entire market. The market portfolio is in the CAPM, or the capital asset pricing model, consists of all risky securities to represent the performance of the market portfolio. Investors use the broad index. For example, the Tokyo Price Index topics and the use of S&P 500 often serves as proxies in the market portfolio in Japan and the U.S. Respectively. And the use of measures security market indexes also serve as market proxies when measuring risk-adjusted performance. The beta of an actively managed portfolio. Yeah, I've read that already. Proxies for asset classes and asset allocation models. Because indexes exhibit the risk and return portfolio profiles of selected groups of securities, they play a critical role as proxies for asset classes and asset allocation models to provide the historical data used to model the risk and return of different asset classes. Benchmarks for actively managed portfolios. Investors often use indexes as benchmarks to evaluate the performance of active portfolio managers. The index selected as the benchmark should reflect the investment strategy used by the manager. For example, an active manager investing in global small capitalization stocks should be evaluated using a benchmark index as an FTSE Global Small Cap Index, which includes 4,600 small capitalization stocks across 48 countries. The choice of an index is to use the to use as a benchmark is important because an inappropriate index could lead to incorrect conclusions regarding the active manager's investment performance. Suppose that the small cap manager underperformed the small cap index but outperformed a broad equity market index. If investors use the broad market index as a benchmark, they might conclude that the small cap manager is earning his or her fees and should be retained or given additional asset to invest. Using the small cap index as a benchmark, that may lead to a different conclusion. Model portfolios for investment products. Indexes serve as a basis for development of new investment products. Using indexes as benchmarks for actively managed portfolios has led to investors to conclude that they should invest in the benchmarks instead. Based on a CAPM's conclusion that investors should hold the market portfolio, broad market index funds have been developed to function as proxies for the market portfolio. Investment management firms initially developed managed indexes portfolios for institutional investors. Eventually, the mutual fund companies introduced index funds for individual investors. Subsequently, investment management firms introduced exchange-traded funds, which are managed the same way as index mutual funds, but traded like stocks. The first ETFs were based on existing indexes. As the popularity of ETFs increases, the index provider created new indexes for specific groups, forming ETFs, leading to creation of numerous narrowly defined indexes with corresponding ETFs. The market vector Vietnam ETF, for example, allows investors to invest in equity market of Vietnam. The choice of index meets the needs of investors. Extensive index providers are constantly looking for opportunities to develop indexes to meet the needs of investors. Equity indexes. A wide variety of equity indexes exist, including broad market, multi-market sector, and style indexes. Broad market indexes, a broad equity market index, as the name suggests, represents an entire given equity market and typically includes securities representing more than 90% of the selected market. For example, Shanghai Stock Exchange Composite Index, or SSE, is a market capitalization weighted index of all shares that trade on the Shanghai Stock Exchange. In the United States, the Wilshire 5,000 total market index is the market capitalization weighted that includes more than 6,000 equity securities and is designed to represent the entire U.S. equity market. The Russell 3000, consisting of the largest 3,000 stocks by market capitalization, represents 99% of U.S. equity markets. Multi-market indexes usually compares indexes from different countries and regions and are designed to represent multiple security markets. Multi-market indexes may represent multinational markets, geographic regions, economic development groups, and in some cases, the entire world. World indexes are important to investors to take the global approach to equity investing without any particular bias towards the particular equity and region. A number of index providers publish families of more multi-market equity and indexes. MSCI borrow offers a number. Okay, yeah, just examples, not really important. Fixed income indexes. A wide variety of fixed income indexes exists by the nature of the fixed income market. The fixed income securities lead to some very important changes to the fixed income index construction and replication. These changes are the number of securities in the fixed income universe, the availability of pricing data, and the liquidity of the securities construction. The fixed income investor universe includes securities issued by governments, government agencies, and corporations. Each of these entities may issue a variety of fixed income securities with different characteristics. As a result, the number of fixed income securities is many times larger than the number of equity securities. To represent a specific fixed income market or segment, indexes must include thousands of different securities. Over time, these fixed income securities mature, and issuers offer new securities to meet their financing needs, leading to turnovers in fixed income indexes. Another challenge and index construction is the fixed income markets are predominantly dealer markets. This means that firms or dealers are assigned to specific securities and are responsible for creating liquid markets for those securities by purchasing and selling them from their inventory. In addition, many securities do not trade frequently and as a result are relatively liquid. As a result, index providers must contact dealers to obtain current prices on constituent securities and update the index, or they must estimate the prices of constituent securities using the prices of traded fixed income securities with similar characteristics. These challenges can result in indexes with dissimilar numbers of bonds representing the same market. As seen in Exhibit 8, the differences between the large number of fixed income securities combined with the lack of liquidity of some securities has made it more costly and difficult compared with equity indexes for investors to replicate fixed income indexes and duplicate their performances. Types of fixed income indexes. The wide variety of fixed income securities ranging from zero coupon bonds to bonds with embedded options called callable or puttable bonds result in a number of different types of fixed income indexes similar to equities. Fixed income securities can be categorized according to the issuer's economic sector, the issuer's geographic region, or the economic developments of the issuer's geographic region. Fixed income securities can also be classified along the following dimensions: types of issuers, types of financing, currency of payments, maturity, credit quality, absence or presence of inflation protection. Fixed income indexes are based on various dimensions that can be categorized as follows: aggregate or broad market indexes, market sector index, style indexes, economic sector indexes, and specialized index such as high yield, inflation linked, or emerging market indexes. The first fixed income index created, the Bloomberg Barclays U.S. Aggregate Bond Index, is an example of a single country aggregate index designed to represent the broad market of U.S. Fixed income securities. It comprises of more than 9,200 securities, including U.S. Treasury, government-related, corporate, mortgage-backed, asset-backed, and commercial-backed mortgage asset-backed securities. Ooh, nobody likes to see a mortgage-backed security anymore after what happened in 2009. Actually, 2008. Damn. Yeah. Mortgage-backed securities. Aggregate indexes can be subdivided by market sectors, styles, economic sector order, characteristics to create some more narrowly defined index. A common distinction reflected in indexes is between investment grade and high yield securities. Investment grade index are typically further subdivided by maturity and by credit rating. The wide variety of fixed income index reflects the partitioning of fixed income securities on the basis of a variety of dimensions. Exhibit 9 illustrates how the major types of fixed income indexes can be organized on the basis of various dimensions. Indexes for alternative investments. Many investors seek to lower the risk or enhance the performance of their portfolios by investing in asset classes other than equities and fixed income. Interest in alternative investment strategies has led to a creation of indexes designed to represent broad classes of alternative investments. Three most widely followed alternative investments classes are commodities, real estate, and hedge funds. So commodities, real estate, and hedge funds. Summary. This reading explains and illustrates the construction, management, and uses of security market indexes. It also discusses various types of indexes. Security market indexes are inavailable tools for investors who can select among thousands of indexes representing a variety of security market segment, and asset class. These indexes range from those representing the global market. Let me drink my water real fast. I'm drinking English breakfast tea right now. Although it literally be 9 p.m. at night, but who cares? To benefit from the use of security market index, investors must understand their construction and determine whether the selected index is appropriate for their purposes. Frequently, an index that is well suited for one purpose may not be well suited for other purposes. Users of indexes must be familiar with how various indexes are constructed in order to select the index or indexes most appropriate for their needs. Among the key points made in this reading are as follows. Security market indexes are intended to measure the value of different target markets. The constituent securities selected for inclusion in the security market index are intended to represent the target market. A price return index reflects only the prices of a constituent securities. A total return index reflects not only the prices of the constituent securities, but also reinvestments of all income received since the inception of the index. Methods used to weight the constituents of an index range from the very simple, such as the price and equity weightings, to the more complex, such as the market capitalization and fundamental weightings. Choices in index construction, in particular, the choice of weighted method, affect index valuation and returns. Index management includes periodic rebalancing to ensure that index maintains appropriate weightings and reconstitution to ensure the index represents the desired target market. Rebalancing and reconstitution creates turnovers in the index. Reconstitution can dramatically affect prices of current and prospective constituents. Indexes serves a variety of purposes. They gauge market sentiment and serve as benchmarks for for actively managed portfolios. They act as proxies for measuring systematic risk and risk-adjusted performance. They also serve as proxies for asset classes and asset allocation models as a model portfolio for investment products. Investors can choose from security market indexes representing various asset classes, including equity, fixed income, commodity, real estate, and hedge fund indexes. Within most asset classes, index providers often offer a wide variety of indexes, ranging from broad market index to highly specialized indexes based on the issuer's geographic region, economic development group, or economic sector, or other factors. Proper use of security market index depends on understanding their construction and management. And thus is reading 45. I finished reading 45. We'll be going into reading 46 in our next reading, and we are going into the last stretch of the level 1 program curriculum. Market efficiency. Okay. We'll be doing market efficiency our next time. So the show notes are in the description below. You guys could go to Amazon and get the show notes. And I do hope my readings have been helpful, and I hope to see you guys next time. Goodbye.